In this video, I want to talk about two misconceptions that often go hand in hand. Bitcoin is too volatile and it's too risky.
Well, probably rat poison squared.
The first mistake that many people make is that they confuse risk with volatility. They think they are the same, but actually these terms are not really interchangeable and mean very different things. Volatility is the variance that displays price changes over time. It shows our subjective perception of value of something through the pricing. Risk, on the other hand, is the probability that an investment will result in permanent or at least long-lasting loss of value. You have a lower risk by buying Bitcoin or other assets at a price that is below their fair value. But that's exactly the problem. The market does not really know yet what Bitcoin's fair value is. It's still too small as an asset class and still in price discovery mode and therefore fluctuates massively. That's the volatility you observe. So let's look at volatility. As just mentioned, Bitcoin is still tiny compared to gold, for example. A growing market cap will lead to lower volatility as the value of Bitcoin becomes clearer to everyone and its price becomes more stable. Ultimately, Bitcoin's lack of a price stability mandate and fixed supply will continue to result in near-term volatility, but will drive long-term price stability. Central banks, on the other hand, manage currencies to mute short-term volatility, which creates the instability that leads to long-term volatility. Volatility in Bitcoin is the natural function of monetary adoption, and this volatility ultimately strengthens the resilience of the Bitcoin network, driving long-term stability. Variation is information. Central banks try to suppress volatility, which often leads to long-term harmful effects. Complex systems that have artificially suppressed volatility tend to become extremely fragile, while at the same time exhibiting no visible risks. A good example is the financial crisis in 2008. The Federal Reserve is not currently forecasting a recession. Well, we know how that one ended. Also, what you notice when looking at the volatility is that since Bitcoin's inception in 2009, its volatility leads mostly upwards. That's something you actually want to be exposed to. Sure, Bitcoin can still fail, but so can everything else through black swan events. The Lindy effect gives an indication that Bitcoin is here to stay. While many short-term bubbles bursted, Bitcoin came back stronger every single time. The longer Bitcoin is around, the longer you can expect it to be around. To summarize, Bitcoin being too volatile is just your time horizon being too short. Now, what about risk? The markets can stay irrational longer than you can stay solvent. Many look at Bitcoin as a high-risk investment, while Bitcoin's fundamental properties tell a different story. When you say something is too risky, that would mean its risk-adjusted return should be low. But Bitcoin outperforms every other asset in risk-adjusted return. And I'll give you another fun risk-related example. The unriskiest investments should be insurances that insure against risk. If Bitcoin is too risky, how come the insurance giant MassMutual bought $100 million worth of Bitcoin? Well, that's because Bitcoin is an insurance against declining fiat currencies like the US dollar. If I had to guess, MassMutual management probably realized that as yields trend towards zero, it is very risky not to own any Bitcoin. To conclude this, you don't need to have or even should have all of your net worth in Bitcoin, but having a 0% exposure to it is actually really risky in terms of opportunity costs.